For decades, the math behind the American dream was straightforward. Get your education, find a steady job, and save your money. If you put in 40 hours a week and climbed the ladder, homeownership was expected. But today, that result is becoming rare. Millions are meeting every requirement, yet find themselves priced out of the neighborhoods they grew up in. The rules of the economy changed while many were still following the old playbook. The effort remains the same, but the output has changed. The formula that worked for previous generations is producing a different reality today. This chart compares median home prices to average salaries since 2000. Initially, they moved together, but over the last 2 decades, the housing cost line violently detaches and spikes, while salaries remain relatively flat. This widening affordability gap accelerates faster than a bank balance can grow. The sticker price of the home is only one part of the calculation. The actual cost is driven by mortgage interest rates. Watch this dial. Even a small increase in the borrowing rate takes a $400,000 home and inflates the monthly payment by hundreds of dollars. The combination of stagnant wages and higher borrowing costs means buyers now require a much higher starting income to qualify for the same houses that were once accessible to entry-level workers. There are also heavy financial burdens carrying over from college and early adulthood, such as student and auto loans. These monthly obligations eat directly into the capital needed to build a down payment. What remains often goes to the urban rental market. This creates a cycle. High rent prevents saving for a down payment, and a lack of savings forces continued renting. While individual buyers are stuck in that loop, large institutional investors have entered the market. Corporate buyers are purchasing single-family homes to create permanent rental portfolios, which reduces the supply of homes available for purchase. Families now compete against Wall Street algorithms, backed by vast cash reserves. The modern homebuyer faces a multi-front economic challenge, squeezed by personal debt and the rise of institutional monopolies. While the old path has narrowed, the objective of owning a home remains mathematically possible. Success in this market requires a strategic, multi-variable approach to personal finance. This begins with an aggressive focus on reducing debt to free up monthly cash flow and improve debt-to-income ratios. Optimizing a credit score is also critical, as every point can lower a mortgage rate and reduce the long-term cost of borrowing. Researching state and federal programs for first-time buyers can provide paths that bypass traditional down payment hurdles. It also requires geographic flexibility, looking beyond saturated, high-cost cities toward emerging markets. These steps represent the new rules of engagement for navigating the modern housing landscape. The era of guaranteed financial success based simply on holding a job has ended. Stability in today's economy demands a higher level of economic literacy and long-term planning. Overcoming the current affordability gap is the result of making informed, strategic decisions over a period of years. Understanding the mechanics of the current economy is the first step toward reclaiming the American dream.